I just finished backtesting three of the most popular volume trading indicators over the past 24 years of historical data. The results were surprising. Here's what I found summarized. Now, to give you some context, each one of these indicators solve different problems when implementing them into a strategy. I will discuss their basic implementation and provide a simple historical backtest, but further testing techniques are necessary for more validation of the results. Now, number one is Unbalance Volume. This is a cumulative indicator that relates volume to price change. When the symbol closes higher than the previous close, all of that day's volume is considered up volume, and the opposite is true for down volume. OBV can be used as a lead indicator for reversals. Now, if you're wondering how the formula looks like, I've attached the formula image here. Overall, it's pretty simple. Pretty much this kind of logic here explains most of it. And many times, if you're trying to implement this with Python or NinjaTrader, for example, you can either look up a Python library that has this indicator, or you can custom make it with the same formula. Now, to give you an idea of how that kind of looks on a chart, you can see how if OBV is continually going down, it's kind of confirming that trend. Whereas if it starts to reverse, then it could be a sign that the trend's actually going to change. And this is kind of like a leading indicator into that. Now, here's a simple backtest, including commissions and slippage for OBV. It enters long when the OBV value crosses an EMA plotted along with it, and sells when it crosses below. I used a daily chart and a 20 EMA. So as we can see, the results overall are not that amazing. They don't beat buy and hold. I think they do beat buy and hold drawdown. So it has a less drawdown than buy and hold over the years. I think this was around 15 to 20%, if I remember correctly. And this was, a lot less than historical SPY averages or even QQQ averages on drawdowns. So it does beat on that side of things, but most people are looking for returns. So this indicator could be something that could be great to implement into a strategy with maybe one other indicator, or for like trend reversal sort of strategy types. But I would say for the most part, this indicator didn't show that much edge just by itself. Next is volume rate of change. This is primarily a momentum indicator which quantifies the rate of volume changes over a given period. Positive volume rate of change indicates bullish volume, while negative indicates bearish volume. So you can see here the basic formula for it. Overall, this one's not too complex as well. And as mentioned previously, if you need these indicators, a lot of just platforms already have them built into them, or you could just use a Python library, for example, and most of them will have that formula calculated for you. Here's a simple backtest including commissions and slippage for volume rate of change. It enters when the volume rate of change crosses above its 10 moving average and sells when it crosses below. I used the daily chart and tested it on a variety of US stock market indexes. Now, you may be wondering, why did I test it over market indexes? Is mainly to avoid survivorship bias data. And also, this was really easy for anyone to implement because here I just used the Yahoo Finance data for these markets. And you can get daily chart historical data for all of these indexes for at least like 20 years of data. Replicate these results, you can just using Python and Yahoo Finance. Now, this indicator did actually show a bit more strength, at least in results. I don't think it beat buy and hold, but it was getting a bit closer. It did beat on drawdown side of things again, like the previous indicator. And overall, I will say that the spread between performance on these particular different indexes was quite vast, meaning that you probably could do a job of rebalancing across these indexes, or you could do a rebalancing strategy across a number of stocks. And you could basically say, whatever stocks have the highest volume rate of change, then you'll pick the top 5 that you'll actually enter in positions on, and the bottom 5 you'll maybe sell the other way around. So that could be one way you could implement it as across a huge range of stocks. And that could probably, at least from a lot of other experienced backtesting strategies like that could possibly be buy and hold, but the volatility on it might be quite large, just because you're probably going to be entering on very, very volatile stocks. If you need a team of quant developers who can backtest and automate your strategies using code, just visit the link below in the description of this video, and you can book a call and discuss with me your particular strategy, and we can see how we can automate it for you. 3 is negative volume index. Now, this is a cumulative indicator made by Paul in the 1930s in the hopes to detect when smart money is active. It rises on days of positive change on low volume and falls on negative price changes with low volume, and remains completely neutral on days with higher volume, whether it goes up or down. So this is just an idea how you can see how the indicator works on a daily chart. Now, I also performed a simple backtest, including commissions and slippage, for this negative volume index indicator. It enters long when there is a divergence between price and the negative volume index, such as when price makes a lower low, but at the same time, NVI makes a higher low. The exit then occurs after X amount of bars. This way, we could keep the parameters extremely simple, and it was less likely to just overfit because there isn't as many parameters here you can actually optimize. The only crucial parameter here that you could really optimize is the X amount of bars for exiting. And then you could probably optimize based on if you could do a rebalance over a number of stocks, or you could just do it on market indexes as I did here, just to keep it consistent with all the other indicators. Now, this one, to be honest, in my opinion, probably showed the most promise. I was actually even looking to maybe build out a strategy around the negative volume index myself and just see if I can get performance any better. Obviously, this is kind of what leads us into the next part of what you really need to do to backtest these ideas further. Now, first, you really want to make sure that if you do put this on historical stocks data and not indexes, make sure you have survivorship bias free data, meaning that if there's been stocks that have been delisted, they should still be in your historical data set and they shouldn't have been removed or you don't have them, because then you're just going to be falling into that survivorship bias. Second, as included already with these strategies, I included commissions and slippage. This is extremely important to make sure you have a realistic backtesting environment that mirrors what a real life trading environment would look like. Now, obviously, the way I do commissions and slippage could be a bit different to you. I just did a fixed amount of dollars per round trip on each index for entering for commissions based on Interactive Brokers commission structure. And then for slippage, I just based it on ATR volatility on the day and took a percentage of that ATR volatility for when it would be entering in. So that is a very simplistic way of doing it, but it is at least better than not including commissions and slippage. So you could modify those to be even more realistic. You could do more advanced techniques, for example, with slippage. But one thing you want to make sure is that you're at least including commissions and slippage, because if you don't, these strategies will look amazing. They'll completely beat buy and holds, but that's just not very realistic, especially if you're pushing size on these particular strategies. Second, as I mentioned here, you really want to do a parameter sensitivity test. This is a really great test to just see how much of your particular strategy could just be lucky due to noise and the particular parameter that you have set. An easy example here is if you had parameters from 1 to 20 on a moving average, and let's say 18.5 produced amazing results, but 18, the moving average period length, produced really bad results, or sufficiently less P&L than the 18.5, then that most likely is overfitted for the reason that you're probably finding a very lucky selection of data there for that particular parameter that is creating amazing results. Ideally, what you want to see on parameter sensitivity is a gradual decline from those parameters. So you'll want to see a natural occurring upcline to a particular parameter number, and then it gradually declines from there. So for example, if I was to have the moving average example, let's say 15 was the amazing, like the best result we could find doing an optimization, then it would slowly decline from 15. And that would be the most realistic kind of way I'd want to see that on a parameter sensitivity. I wouldn't want to see a strategy that has tons of spikes in its kind of 3D surface graph for a parameter sensitivity. That most likely is going to say to me that it's probably overfitted. And then next, you really want to run a Monte Carlo on these as well. The sequencing of these trades could be incredibly impactful in the actual results itself because they are daily swing strategies, meaning that I have run them over a good amount of indexes. So there's a good total amount of trades, but realistically on per index, there's only about maybe 100, maybe 200 trades max over that whole period of time. So you would want to run a Monte Carlo on the whole portfolio itself of trades, and you'd also want to run it on individual symbols as well, because you just want to see how much that trade sequencing affects the max drawdown, the risk analysis, the returns, the consecutive wins and losses, the win rate, all those sort of things, to actually get a more realistic idea of if this strategy is actually robust. Now, as a reminder, these are simply ideas that I hope to provide you with a bit of inspiration for your own strategies and your own development process. As Jim Simon says, you're always going to need more strategies to plug the hole for previous strategies that are losing their edge. And through this, I constantly do my own research, and then often I share some of it on Twitter to hopefully give you some inspiration on what you could be doing to build or modify your own strategies. I know this was a quick video, but I hope it helped, and I hope it provides you some inspiration for the weekend.